And I'm going to take, just know that that 697.5 level, that's the midpoint between the dealing range high and the dealing range low. And we would anticipate a break below that low later on. But that has to happen after. Now, if you're not writing these steps down, you are wasting your time, because this is the recipe I use every single time. Now, that fair value gap is above the equilibrium price point, which is the midpoint between a range high and a range low. A gap is like this little shaded area here, okay? A gap or inefficiency is always going to be measuring the middle point, and we'll call that consequent encroachment. Now, why did I name it consequent encroachment? Well, it's consequential to what you're expecting in price action for it to reach up into the midpoint of that inefficiency. And where's it encroaching to? The midpoint. Many times you'll see it trade and reprice to the midpoint of a gap or inefficiency and fail to go any higher. That's ideal. Remember when I was telling you about the daily chart with that buy side imbalance, sell side efficiency? If you're trying to trade that as a bullish PD array, where it would be a discount array where you're trying to buy it, the best buys are going to happen from the midpoint to the high of it. You don't want to see it trade down in the lower part. Why? Because if it stays open, that is a breakaway gap. You want every time when you're trading an inefficiency, you want to see that other half of the extreme of the range that creates that inefficiency or that fair value gap. You want to see it stay open. But today, I walked you through the process, how to define a range that makes it a dealing range. If you're bearish and your bias is bearish, you want to see buy side taken. Even if it's by one tick, it's done its work. Then you want to see sell side taken. Once that happens, now you have a defined range. That is a dealing range. Why is it a dealing range? What makes it a dealing range? Because they're going to deal with the midpoint of that range. That's this level right here. So the algorithm will reprice at 830 right here. It's going to go up into that equilibrium price point here and seek a premium array. That's not a gap. That's a gap. So it trades into it, overshoots it. Are you going to get scared and nervous? No, absolutely not. When you're trying to learn how to do this, you're going to see that candle open up and trade bold-faced bullish like that. And you're going to think, oh, I'm wrong. And you need to change that mindset. Because if you're bearish, you want to time Judas swings formation. 8:30, the news drivers are coming out right here. The market opens on that candle, trades down initially, sweeps that low. Okay, that's wonderful. Now we have done what? What did we do? What did we do? We engaged sell side. So now we have our range. It's defined now. So we can drop our fib here up to that high. We're bearish, so we want to see a Judas swing. We wait. We're not freaking out. You watch the market rally up, because that's exactly what's going to suck the retail traders in. Because there's a lot of folks who are going to see that low here, and they're going to want to buy it. Because why? They think that that's support. And they're going to do what? Get burned. You're not trying to trade a breakout. That's not what you're doing. You want to see a Judas swing, which is opposed to the direction you think the market's going to go. That's that February 21st low. The fair value gap. Is it above the equilibrium price point? Yes. The market protracted higher. That's our Judas swing. That means it ain't taking that high out. So what is it going to do? We want to see it trade lower. It does. But then what happens? It trades lower, takes that low out. So now we have a break in market structure. So inside of all this price action that would frustrate you, why is this marking time like that? What is it doing? I want you to look at the bodies of the candles in here. You see that? These are this whole section of price action. If we look at that here, and that's your lowest body in here, all this consolidation right in there. See that? That's on a 5-minute chart. If we take that and we go into a 1-minute chart, that's intraday. So right now, that's what we're doing here. The physician is looking at the lower time frames to get a feel for what it's telling them. As a technician, as a trader, when we're looking at price action, we're doing the same thing. So we want to look at these little areas here where there's a problem. What's going on? It's not moving, but it should. Remember, it should be moving lower. But why isn't it moving lower? It's waiting for something. What's it waiting for? 9:30 opening bell. So all of this right here is time distortion. That means you have to submit to where you entered, where your initial stop loss would be. But all of this in here, because of the waiting element that needs to be worked through, okay, we had 8:30 news driver here. We went up to the premium array, swept it one more time. They bumped the high here. So now the market should go where? Lower. But it goes lower just to take out the low, and then it's chopping back and forth. So what we would look for, if you're down in the lower time frames, that low and that low. You see that? The market drops below it here. We don't need it to trade below that yet. It's already done that here. Everything is geared for it to break lower. Every time after that stop run right there, every high was lower. Lower than that one. See that? So all it's doing is giving a signal to smart money that everything's the way it's supposed to be, and every single time we're inside this range in here, they're adding more to their shorts. And retail's hoping that that was support, and they're trying to buy it. But watch what it does. It does break below these lows here on that candlestick. And then the market trades back up into a bearish order block. This candle and that candle together, that is an area where inside that range, if the market can touch that area once more, treat it like the same way as trading into a fair value gap, like what I showed you on the 5-minute chart up here, that you're entering in there. This range right here, that's them getting in the last bit of opportunity in terms of timing, or they can go short. So these up close candles, I don't really need that second one because now I can see that this one is shorter than that one. So this is the order block because this is inside the range of the previous up close candle. What is an order block? What is it? It's the change in the state of liquidity. Okay, it's where you are in the marketplace and how it changes its delivery, where it pinpoints a very specific time. It's specific in elements that provide you a very unambiguous range in price, where if it can trade to it, think of it the same way you do with what I taught today with the fair value gap. If you're bullish and market trades higher and trades back down into the fair value gap, you want to try to key up an entry with all things being equal and it's still bullish. The equilibrium price point, or if it's a fair value gap, it's the consequent encroachment, the halfway point. Or if it's a candlestick that makes an order block, the midpoint is mean threshold. It's expected to at least try to trade into it halfway. Those halfway points are important because if it can go to just half of it or fall short of half of it when you're bearish, or go down to half of it or trade just above halfway and then go higher, it indicates a signature in terms of strength of the move. It gives you that little bit of detail to say, okay, yeah, I'm not only am I on the right side of the marketplace, and it's probably going to start moving in my favor, but it's really going to move in my favor because it couldn't even trade to the midpoint. You see what I'm saying? It's a diametrically opposed contrast to what I was saying about stop hunts. You want to see a stop hunt where it goes against your direction, because then it really gives you an indication that it's going to move a lot, because now somebody has been unseated, and the only people that do that is the smart money. The smart money that will capitalize on someone else's missed opportunity, and then they ride the longer run higher or lower. Well, it's different when it comes to order blocks. You want to be able to see it not trade to the midpoint or mean threshold, but you allow for it. But your stop loss has to be outside the parameters of the order block. In this case, We have this up close candle here. Okay. If we can trade up into it, like in here, where it does that, this range here, I'm going to throw a fib. I'm going to take this range off the box so that way you can see what I'm measuring here. This to here. That's the midpoint. Okay. Or what? Mean threshold. Mean threshold measures at 17678.75. What's the high of that candle? Holy shit. What's the chances of that? Right to the tick. But this order block here, there's a certain caveat that needs to be applied to this. I'm referring to when we're talking about volume imbalances. The volume imbalance is the difference between the candle that you're looking at and the one prior to it. Okay, so it's only a 2 candlestick or 2 time interval. That's a more specific way of defining it. 2 subsequent immediate candles or time intervals that have a measurement of the open or closing price that do not touch. See that? Now, if there's no wick, being shown in the delivery of the candlestick, or when the candlesticks paint on your chart, they, by theory, you can have a candlestick like this, where there's the highest high and the lowest low is the open and the close. It's rare, but it happens. But what we're looking for is the difference between the bodies. Okay. So if there's ever a separation between the two, like this, and the wicks can have this, like it could do, the wick could come all the way down into this area here. So it could eventually be viewed as it's overlapping. And the wick on this candle can go all the way up to here. But my eye and I'm training you as a student to look at that separation between the bodies, because the majority of the volume of trading is done inside the body of the time frame that you're measuring. But this is a volume imbalance. So what you do is you have to incorporate this little range in price action. That has to be factored in your analysis. Now that might act as one more instance where you can trade up into it and you're not going to add another partial for a pyramided larger position. Or it could be it's going to trade up to that and that's my exit. Or it could be I have to use this as that's my third PD array and I'm bearish. So now I have to put a stop loss above this. So where would the stop loss need to be? It needs to be above the candlestick's high that forms this volume imbalance, which would be this candlestick right there. This candlestick need not be a swing high. It could be another high over here. And it wouldn't look like you would pick that candle. But it's the same framework I use for what? A fair value gap. So it shares similarities and characteristics for managing and employing it for entry, partials, and now I'm introducing how to use it for stop management. So if you're using this as an order block, there's nothing wrong with that, but you just can't just say, well, that's my one trick pony and it answers everything for me. No. Your entry needs to be inside that candle's range, yes, but you also have to define the risk, because now you have a volume imbalance that's inside this candle here, right before this 2 consecutive candles, but we've learned that this is not important because this one's the entirety of the range. And let me say it slower and simpler. This up close candle is not relevant in terms of defining a order block. This candle's high is above this candle's high. So we don't need to even refer to this. So that's why I measured that range with the box, showing you that up close candle is the order block. It does trade up into the volume imbalance, but volume imbalances, you have to be what? Flexible. They can pass through them and be used multiple times. So because that is there, you have to define the risk with, okay, what's the candle that creates that volume imbalance? The high end of it. It's this candle. So your stop would have to be where? If you're going to use that as your entry, your stop has to be above this candle's high by 1 tick. Where I teach the PD array matrix, and I show you where all the PD arrays exist and how they nest together and what order they form. You do not see me introduce the volume imbalance in there. Why? Because the volume imbalance can appear and form anywhere in the spectrum of your dealing range. But they all are influential. So if you have a volume imbalance inside of your dealing range, in the time frame and time frame that you're trading off of, you have to extend them to the right because they will absolutely have an influence on price. And how do you use that? With managing a stop, you have to factor in the fact that, yeah, price should only go into that volume imbalance, but the rules for using it is you have to allow for static price action. Remember, it can color outside the lines, especially during high impact news driver days like today was. So your stop loss has to be here. Okay. What happened for us? 5-minute chart. Let's go into that. All right, so now we have that fair value gap right here, okay? Finish with this business here on our order blocks. But we have the fair value gap I pointed to live. Before it traded up into it, then I said, it's done. It doesn't need to do anything more. It's done enough for me. Now, if you're using that as your entry strategy, or if that's your model, okay, it overlaps with multiple things here. It overlaps with these consecutive up close candles prior to this rotation lower, and that shift in market structure below that low there. So you got to go back inside all this price action here. Where's your up close candle? You can't use just this one because you're not getting the full picture. Because if you're demanding it trades all the way back up to the low of that candle, you're going to miss trades. You're going to miss them. Okay. So how can you manage risk appropriately? How can you still engage the market using an order block correctly? And as its author, me, I can tell you right now, this is what you do. Okay. The up close candles that are in succession here, one after the other, that entire range has to be defined. That's one entire range. Now, you don't know, and I'm not going to be able to teach this part of it to you. So I give you the easiest low-hanging fruit objective on how to incorporate them in your trading. You may come away with this range here. We have the high and the low. Okay, that is your range for a bearish ICT order block. Okay, in that range, you grade it. So we have the up close candle. We're not measuring this low here. Why aren't you using that low ICT? Because it's not an up close candle, and it's the time frame we're using here is the 5 minute. Why am I using the 5 minute chart? Because it's a high impact news driver day, and you're not allowed to trade with anything less than a 5 minute chart on a news impact event that's high impact. So this up close candle, that is the low end of your bearish order block, and then the high end is where the last up close candle, its high is. Okay. And now we put the lower quadrant, the midpoint, which is mean threshold, and the upper quadrant in the high. In an ideal world, just like the same logic when I'm using my fair value gaps, okay, if I'm trading inside of a buy side imbalance or sell side inefficiency, the scope is the same, okay? Ideally, I want to see a sell form between the low and mean threshold. That's the ideal, if you want to call it optimal area of entry inside a range that is an order block. So this is where you want to be looking for your shorts. Can it trade all the way up here? Yep. What happens if you enter in here and it stops you out? You just took a trade prematurely, and you wait and see, does it give you more indication that it wants to go lower, but it needs to leave the premium side that makes this range. So if it goes up there, you're gonna have to wait for it to make a low, break the low, and then the next inefficiency after that, because then you'll have what? A market structure shift inside the range that acts much like what? A dealing range. So your order block is what? It's a dealing range. But it's very specific with this part. What I'm about to show you right now, this is what makes an order block, okay? We're gonna take this range here from the low to the high, halfway point, that little area here, that's a sweet spot. That's your point of where the best of the best entries are going to form. So in this range here, what do we have? Well, we have a breaker. That's in the lower area too, lower half of the order block range. We have the fair value gap here, and we also have the optimal trade entry. How many things are there saying that this is going to go lower? Multiple, right? Any one of them could be your unique trading model. Is any one of them better than the other? No. None of them have any distinct advantage over the other. So when I'm taking a trade, I don't just have one thing saying I'm taking that trade. See, some of you don't realize I'm answering the question that a lot of you have been asking me. Why did you pick that and not this? Because I have a confluence of the things that I use and can employ as a trader to get into a trade. I don't just have one of my tools saying this is a trade. I have multiple things saying this is a trade. So If you were utilizing this fair value gap here as the entry, where would your stop have to be? Not this. You can't be this high. That candlestick's low is the high. It's the high watermark of that shaded area, which makes my fair value gap. This candlestick's high is the low of the fair value gap. So the candlestick that makes the barrier high in a bearish fair value gap, that candlestick's high plus one tick is your stop loss. When do you use the last up close candle before the down move in price? If you're looking for a bearish order block, you'll have a series of up close and then maybe one or two down close candles, and then you'll have a down close candle right before your last up close candle. Okay, if there's a break in this, for instance, let's say this candlestick right here was a down close candle, or it would be a black candle for my charting, then I would have used that candle as my bearish order block, and none of this down here would have been a factor for it. How's that for simplicity? Real simple, isn't it? But if you ever have a series of immediate consecutive candles, you have to define the range that all of those candles make. Divide it in half, divide it in quarters, and the best setups are going to form below mean threshold, which is the middle of the entirety of the multiple candlesticks that make up my ICT bearish order block. Also, the importance of, if you're buying down close candles and you're treating them as a bullish order block, you absolutely do not buy a down close candle that's outside of the range that just broke. Okay? Never do that. Okay? Because you don't have the experience to know if that range being broken to the upside is going to be sustained. You don't want to do that. So what you want to focus on is this. You believe the market's going to go up here, and we traded, and now we created a dealing range, and I've already defined how to determine a dealing range, but your bias says it's going to go up here. Okay? In this run here, that's your dealing range. Splitting that in half, where is the ideal entry points for a order block? Is it down here or up here? You want to see a down close candle in the upper portion of this range right here. So it would be like this. That's your area where you would look for a down close candle in here. Okay? Caveat. If there is a fair value gap on the time frame you're looking at in this range or the lower half, you do not buy a down close candle in the upper portion because it won't hold. It will drop down and reprice to the inefficiency that many times will have a order block associated with the fair value gap. Okay, so that's why it's important that you start with one PD array, learn it, but it's not going to stop there. You're going to need to know the PD array matrix, even if you don't use them as entries. Understanding what they are and how they form inside of a price run, it's part of the whole process of determining, why do I buy that down close candle and not that one? Why do you buy that fair value gap and not this thing? How are you able to pick this PD array and you ignored this over here? I just taught you today. And that's what this over here teaches you. Right, but the people have been doing this for a while. They just had an epiphany right there. They're understanding now why their down close candles they thought was a bullish order block went right through it and went lower, but still respected the dealing range. Didn't go lower than here. How do you know when to buy it down here and when to buy it up here? He's buying at a premium. Why is he buying at a premium? His video says, I just told you why and when.